So how did the real estate market perform last month? Well, not so good, actually. So I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. We help people invest in real estate to be able to build wealth. So every month I give a market update so that you understand what's actually happening in real estate, the real numbers, the real insights about what's actually taking place. And this is the March 2026 real estate market update for the Las Vegas Valley. That means that we're looking at the data, the complete data for the month of February of 2026, and we're making month-over-month comparisons, so January through February, and year-over-year comparisons, so February of 25 through 26, through February of 26. I want to give just a minute of really quick background here to sort of set the stage, and then we're going to go into the data itself, and we're going to look at what happened in the month of February for residential resales in the Las Vegas Valley. And then at the end of the video, I'm going to give a sort of summary of what's taking place, because I think it's really important this month to contextualize it sort of after I give you the data, because the data themselves are a little bit surprising this month. And so I want to give an analytical summary at the end. So stay tuned for that. Okay, so the background context, interest rates in February remained high. They remained just a little over 6%. Now, if you were paying really careful attention to interest rates, you know that so far this year, we've seen 2 days where interest rates may have gone down to 5.99%. That's for 30-year fixed rate residential mortgages. Now, I say that's for 2 days. It's 1 day earlier in the year and then 1 day during the month of February. Actually, the very beginning of March, not actually in February. However, outside of those 2 particular days, interest rates have been hovering in these sort of 6.1% plus or minus 5 basis points, so 6.05 to 6.15% for most of this year so far in 2026. Now, if you're paying slightly less attention, but you've been reading and noticing things about interest rates, you may have been hearing, oh, interest rates have been falling and they're doing amazing things and it's getting so cheap to borrow money. And the reality is absolutely not that. Interest rates are holding steady with some fluctuations, some level of volatility, but they're basically around 6.1% so far this year. The reason that you see these alternate headlines or sometimes ads in the paper or online is banks may be competing to try to get you to apply for a loan from them. And some of the stuff is a little bit artificial. Some of the stuff may be, well, we'll give you a teaser rate for a year and then it's going to pop back up. The artificial stuff is actually, we're offering the artificial stuff is actually like, we're offering 5.85% right now to highly qualified buyers. And so you call them up, you try to get the loan, or you try to apply for a loan and get the information, and you find out, your credit score is below 810. Yeah, you don't get the very best rate. Oh, this thing? Yeah, no. So you're going to be looking at 6.25%, not at the advertised 5.75%. Right? So there's a lot of noise out there, but when you're actually looking for interest rates, according to the Mortgage Bankers Association, the national average for interest rates remains about 6.1% for 30-year fixed rate mortgages. Okay, so that's what interest rates, right? High, not as high as they had been, but they're still high. And there's volatility and noise around them. Now, there's one other thing I want to talk about really quickly, and that is the price of oil. Right? So oil is one of those things that impacts all people directly as well as indirectly. So if you have a car, you're probably putting gas into that car, or you're buying electricity to charge your EV, right? And the electricity rates may be influenced by how much it costs to run an electricity generation plant, which may be fueled in part by natural gas. So we also see that there's distribution, right? If a good is produced someplace, it has to be distributed to some other place where you're going to get it, and then maybe ultimately delivered to you, right? So that increases distribution costs if we see fuel prices going up. Well, oil, WTI, West Texas Intermediate, sort of the benchmark crude oil number for American crude. That's a well-traded contract on the Chicago Mercantile Exchange, the CME Group. And that contract has been running below, or not below, but rather between about $52 and $57 per barrel for much of the year. There's been some spikes higher, nothing going below about 51. But at the beginning of March, the U.S. decided to start blowing up a lot of Iran. Good, bad, whatever, it's had a significant price impact on oil. And so WTI, as of earlier this morning, and I'm recording this on the Monday the 9th of March, had gone all the way up to about $120 a barrel, about 119 actually. That's an absolute doubling from 55, 57, 58 dollars that we had been looking at just a week ago in the oil market. And Brent, which is the UK equivalent of WTI, that's actually trading even higher. It usually trades a little bit higher than WTI. So the oil complex, the energy complex, is showing a huge amount of inflation right now. And as I mentioned, that is inflation, and that passes through to a lot of goods because of distribution channels, because of other energy production issues. So we're going to see a spike in inflation as we move through the month of March. We don't know how long that's going to last, but we're looking at real inflationary pressures. Okay, so that's background. So let's go ahead and look at the real estate market now. And I'm going to caution you, the real estate market in Las Vegas for resale residential in February of 2026 was unhealthy. There's not really any other way to describe this. And so we're going to look through the data, and then I'll give you that summary at the end, sort of a summation of what's going on in the market. Okay, so this is important to pay attention to. This is structural change in the market from what we've been looking at before. We know before, yes, sales were low, inventory was low, interest rates were high, and etc. Right, and back on markets were high. So we're seeing something a little bit different now, and I want to make sure that you're all aware of what that actually is. All right, so first thing I look at is pricing. So pricing for single family residential, what's the median sold price for all of those contracts that closed during the month of February of 2026 for, again, resale residential here in the Las Vegas Valley. So I segregate out all of those new construction homes that made it into the MLS. And the data, by the way, they were captured on Saturday the 7th of March, so that the February numbers are complete. I always capture the data on the 7th for comparability across months. So prices for single family residential resales went up. They went to $469. Now, this is significant. They had been at $455 in January, and I had noted in the February market update where we looked at that January number that was probably a temporary spike down based on a couple of issues, and we'd likely see a rebound. Well, we have rebounded. We've rebounded 14% or 3.1% on the median sold price. And we rebounded to 469. Now, the 469 number is interesting because for most of 2025, the median sale price for this type of product, single family resale, was $470. So we're $1,000 below where we were for much of 2025. So in other words, no statistically significant change from where we were last year. We're actually from February of 2025, we're down 0.1%. So that would be, $400 and something, $470. So in other words, year over year, no meaningful change. Month over month, we were up. We were up significantly, 3.1%, and it's because we were correcting the statistical issue that occurred in January. And no surprise there. I have warned you this is likely exactly what was going to happen. Warned you that this would be a good number in February, and so it was. All right, but what about condos and townhomes? So let's look at condos. Condos, median sold price, 221,000. That's down $3,500 or down 1.5% month over month. It's also down 6.0% year over year. So clearly we saw weakness in the condo market in February of 2026 in terms of pricing. And this is not just a statistical fluke, right? We're down 6% year over year. So from February of 2025, this is actually some significant pricing movement on the downside in the condo market. Now remember, condos are thinly traded, and so that means that there's fewer transactions, and when there's fewer transactions, we get more volatility. That means bigger changes, both up and down. It happens literally because there's fewer products being traded. Okay, so if you had only two condos that had sold, there were more than that. But if you, for example, had only two, and one of them sold at $190,000 and another one sold at $210,000, that median would be $200,000. But what if the following month we had two condos sold, one at $200,000 and one at $300,000, right? Because it was maybe a higher end condo in a nicer area. Well, the median would have jumped all the way to $250,000 because the median is the middle of the market, the middle of all of the transactions that occur, right? So when you've got smaller numbers, a smaller N, as statisticians would say, a smaller number of actual iterations of something, then we get more volatility, both bigger spikes up and down, and the volatility becomes more common. It's a bigger feature of the market. Okay, so remember that anytime we're talking about condos, anytime we're talking about townhomes as well, the townhome market's a little bit smaller than the condo market here in Las Vegas. So what happened in townhomes? Well, median sold price, $325,500. That's down $4,500, down 1.4%. And it's down 4.3% year over year. So again, same note, smaller market, more volatility, but this is meaningful change on a year over year basis. We've gone down month over month and year over year significantly in the condo and townhome spaces for resales here in the Las Vegas Valley. Something to note. Now, I'm not saying it's a problem. It's not a great big drop. It's obviously not an increase, but it's something to note that we're seeing some pricing weakness in the multifamily segment, the condo and townhome submarkets in Las Vegas, even while median home price for single family went up by 3.1% and we're approximately flat year over year. Okay, so let's go ahead and look at the next statistic now, which is demand, or number of transactions that actually closed. Okay, February 2026 resale single-family homes, 1,482. Now that number's up. It's up, nicely, 183 units, or 14.0% month over month. Now, remember, this is February. February it's still winter, but it's the start of the recovery from winter, December and January numbers, and movement into the spring selling season. Okay, so we expect February numbers sold numbers always to be going higher than what we saw in December. And we did. We saw 14% gain or 183 unit gain for single family homes. But this number was down 6.0% from what we saw in February of 2025. Okay. Now, condos. Condo sales also up 211. That's up 33. It's up 19.2% month over month. But again, it's down 11.3% year over year. Okay. And townhomes, 156. Now it's up 41. That's a pretty strong 26.1% month over month increase in the number of townhomes that sold. And by the way, bucking the trend for single family and condos, this is actually up 1.0% year over year. So from what we saw in February of 2025. Okay. Now, two insights that I need to give you with regard to these sale numbers. The first is with regard to pending sales. So pending sales are what have gone into contract but not yet closed, and we expect to see close the following month. So when we do the March update, the April update with the March numbers in a month, we would expect to see the impact, the influence of these pending contracts. So pending sales were up strongly for single family residential resales. Okay, so that's a good thing, but they were only up seasonally, right? So we expect to see bigger gains with March numbers for sales because that's actually the beginning of the spring season. And so we expect significant growth in February. We saw some, but only seasonally. And we expect significant growth in March, and in fact in April and May as well, with some growth perhaps in June, and then a small deterioration likely in July. In the Las Vegas Valley, that tends to be the pattern, right? So we did see pending contracts increase for single family residential, but condo and townhome pending contracts were weak, right? They were, in fact, very weak. They showed very slight growth, way below seasonal norms that we should be expecting to see at this time of year. So if we're thinking about what the pending contracts look like for future sales for the April update next month, it suggests that, okay, we'll see growth in single family sales that should be approximately in line with seasonal trends. And we should see condo and townhome sales under pressure. They should be increasing, but just a little bit, okay? Not normal for seasonal patterns. And this is actually one of the unhealthy challenges in the market right now. The second insight, 2026, I noted that relative to 2025, single family and condo sales were below the comparable level 1 year ago. Well, actually, single family resales and condo resales, lower number than what we saw in February of 2025, lower number than we saw in February of 2024, and lower number than what we saw in February of 2023. Now, I comment specifically on that because you'll remember in the annual review video that I put out in February, the numbers, and I had alluded to through the back half of 2025, 2025 is the lowest transaction volume that we've seen in Las Vegas residential real estate in a generation. In fact, on a per capita basis, it looks like you have to go back to the 1970s during the oil crises in the 70s, when we were also in a recession, to be able to find lower sales on a per capita basis. So 2025 was astoundingly weak. And by the way, 2024 was just slightly stronger than that, and 2023 had been the weakest in a generation until we got to 2025. Right? January and February were below what we had for both of those months for single-family residential resales and for condo resales, right? We're below the 2025 number, we're below the 2024 number, we're below the 2023 number. So 2026 is starting in terms of sales very weakly, right? And we're a sixth of the way through the year. So this isn't like just a single 1 month aberrant issue. Transaction volume has slowed even further from what we saw last year. That's a negative and unhealthy issue with regard to the market, right? We're below the generational lows that we put in last year. Okay, now the next statistic, inventory. Now this month I did not break out real and fake inventory. I'm just giving you listed inventory. Okay, so those are the numbers that we're going with. The prior month update, we looked and we saw that actually literally 50% of listings were fake inventory. So we could assume, because of drag in the statistics in the marketplace, that it's about that still in February. But let's just look at the listed number of properties for sale instead of trying to break it down further for the February numbers. Okay, single family resale listed for sale, 6,317. That's down 367, or 5.5% month over month. Now that's a really problematic issue because we're going into the spring selling season, right? We're coming out of winter. We should be seeing increasing inventory. We saw decreasing inventory. Okay. Now we're up 1.8% year over year for single family listed inventory. Okay, so that's single family homes, right? We're down. Inventory came down despite normal seasonal patterns, right? Well-established seasonal patterns coming out of winter. We see growth in inventory, and then going into spring, more significant growth in inventory. Single family homes down 5.5%. What about condos? Condos, a little bit different story, maybe. We saw 1,530 condos listed for sale, sitting in inventory in February of 2026. That's up 0.1%, or one condo. That's it. We increased inventory by one, way below what we'd be expecting. We're up 3.3% year over year. Okay, what about townhomes? Well, townhomes, 1,009 townhomes listed for sale in February of 2026. That's down 3. It's down 0.3% month over month. It's up 22.1% year over year. Okay, so let's talk about these year over year issues for just a second. In all three submarkets, we saw year over year growth in inventory showing sequential declines from the month prior. And this is now an 11-month trend, right? So a year ago, we had a little bit less inventory than we happened to have at the end of February of 2026. But except in townhomes, we're pretty close to flat. We're up 1.8% year over year for single family residential. We're up 3.3% year over year for condos. Yes, in townhomes we're up a lot, but that was because of really significant inventory problems in townhomes last year. Okay, all three segments, less increase in February than what we had seen in January, and et cetera, going back 11 months. Okay, now the next interesting issue with regard to inventory or supply in the marketplace. Critically, new listings, right? So we can think of stable inventory. That's the stuff that's sitting in the market at the beginning of the month. And it may be the same, it may be different individual units, but sitting in the market at the end of the month, right? We've got 1,000 units for sale, and we have 1,000 units for sale, okay? But for everything that gets sold, there may be something else that comes into the market. For things that expire, the listing doesn't sell. There may be new things that come into the market. Well, actually, we expect both inventory to be growing seasonally, and where most of that inventory growth is usually going to be coming from, right, isn't from decreased sales and just inventory sitting there. It's from newly listed product coming into the marketplace, right? So new listings are where we generate inventory from. Critically, new listings fell significantly in all three submarkets. At the very time we should be building inventory going into March, going into the spring selling season, new listings, which is where that additional inventory growth should be coming from, fell across the board, all three market segments, completely counter-seasonally. And these declines were not like the 1 or 2 or 3 numbers. There are significant percentage declines in new listings from what we saw last year. Right? That's a really unhealthy issue. So we're going to come back and look at that. Now, again, I'm only looking in the February update at listed inventory. If we were to think about this as being in January, the inventory was half fake. That means that in single family homes, if we say it's still 50%, we've got less than 3,200 homes. We've got 30% of normal inventory sitting in the market, and new listings are going down. We have an inventory problem, a significant inventory problem, and it's getting worse. Okay, now the other statistic that I give every month is back on market, and that is failed contracts that end up being relisted, right? So this is an undercount for failed, because failed contracts might disappear and not become relisted. They might convert to something else or what have you. So this undercount, probably not huge. It gives us an indication of failed contracts. There's always going to be failed contracts, but not like this. And we've been seeing this since October of 2020, right? This is a long-term issue in the market here in Las Vegas, and apparently it's spread across many markets across the country. Single-family homes, in February of 2026, of the contracts that were written, 613 failed. That's a 29.3% contract failure rate. Again, using the back on market statistic, which is an undercount of failures. Condos, 100 contracts failed. That's 32.2% of condo contracts failed. Virtually a third of buyers and sellers signed a contract, were moving forward with the contract, trying to actually execute on the contract, and things collapsed, and no exchange of property, no exchange of the purchase price, right? Buyer and seller is stuck. Townhomes, 76 failed. That's 32.8%. Again, virtually a third. All three of these submarkets, virtually a third of contracts have failed and gone back in the market. Hugely elevated, massively problematic number. And again, this has been continuing between 25 and 33% for the real estate market, all submarkets in Las Vegas since 2020, since the pandemic. Really problematic. Okay, so let me give you a little bit of a summation here, because I told you this market has kind of transitioned into a different phase. It's no longer just, we have low transaction volume because there's not a lot of inventory and there's high interest rates. And so buyers are either priced out or they're not seeing what they want. We're starting to encounter something different here, right? And when I say the market's unhealthy, I don't mean that it's going to collapse. I don't mean there's no transactions that are going to take place. I don't mean that prices are going to be falling, right? Nothing like that. This is some people have been characterizing this as, it's becoming a buyer's market. No, it's not becoming a buyer's market. A buyer's market means there's a lot of inventory and buyers have negotiating power. Some individual buyers might be able to have some negotiating power on something. A seller's market, conversely, means that there's a lot of buyers and sellers have negotiating power. Well, there's not a lot of buyers out there right now for various reasons, including high interest rates, some level of challenge on affordability, high levels of uncertainty where buyers might hold back and say, I'm just not sure I want to do this right now. Right? And what's the uncertainty? Well, it's manifest throughout the environment, right? So here we are in March. The Department of Homeland Security still is operating without a budget for fiscal year 2026, right? And so it's still doing some operations because of funding that it received from the prior year from some legislation, but literally the Department of Homeland Security does not have a budget right now. It's the last of the federal government departments with no budget. Well, this has been going on now for 3 months, 3 weeks as I record this video. Will they be funded? Probably at some point. But there is significant political contestation about what they should be able to use the money for and about the activities that they're engaged in and whether or not those activities have any sensibility to them. We're at war with Iran. And by the way, when we went and kidnapped Maduro, I suggested that had not been on my bingo card, right? That was uncertainty that nobody had been thinking about. Well, the bombing of Iran, that's uncertainty that a lot of people have been thinking about, including me. So this isn't surprising, but seeing what's actually transpiring and seeing the impact on Gulf countries close by to Iran, and seeing the closure of the Straits of Hormuz and the spiking in oil prices, these are all negatives, and sure, they're foreseeable. They shouldn't be a surprise to anybody, but high levels of uncertainty. And of course, healthcare costs have gone up significantly, right? My healthcare premiums have gone up over 100%. And I'm certainly not alone, right? Very large numbers of Americans, very large numbers of Nevadans, very large numbers of Las Vegans have seen their healthcare costs escalating significantly, right? And so we're sitting in this inflationary environment where inflation is actually getting worse, where certainty about what's going on in the macro environment is getting worse. That causes a lot of buyers to hold back and say, I'm not sure I want to commit to something really big, structural, long-term right now. I want to see what's going on. Okay, so that's part of where it's coming from. So anyhow, what are these unhealthy signals? Well, one, extremely low volume of transactions, right? Last year I had been commenting, and in 2024 I've been commenting, we had shifted from a want to real estate environment to a need to real estate environment. The people who are buying are the people who need to buy, and the people who are selling are the people who need to sell. Right? So why might you need to buy? You've just been relocated here for a new job. You've just had a birth in the family that turns out to be triplets, right? There's a death in the family, and or divorce in the family, or a marriage in the family. There's things that cause people to have to buy a new home, or at least to have to move, right? And so maybe they're not buying, maybe they're moving into the new rental developments that have opened. And those are not necessarily perfect solutions, but they may work well as temporary transitory solutions that go for a year, that go for 2 years. Why do people need to sell? Same kinds of reasons. They might be transferred. They may have a death in the family. They may need to move to a bigger or more stable place, or to a smaller place. Loss of job, right? So those are need to type reasons for real estate transactions. Why do people want to engage in a transaction? Nicer home, bigger home, nicer neighborhood. Or conversely, I'd like to downsize, take some of the money off the table, use it for travel, et cetera, right? The want to buyers and sellers had already been disappearing from the market, and we had become a need to real estate market here in Las Vegas during 2024 and during 2025. right? Well, we've got lower transaction volumes now, which suggests that some of those need to buyers are not just deferring, they're making alternative plans. Maybe they're not moving to Las Vegas, or maybe they're renting instead of actually buying something. Worse, the need to sellers. And this is really an unhealthy signal. We've got new listings have come down at exactly the point in time in the market where new listings seasonally should be increasing. Sufficiently, the inventory is increasing. And we saw new listings in February come down across all three submarkets, single family, condos, and townhomes. That's a change from what we've been looking at before. Okay. Back on market, yeah, that's been elevated for a while. Slow transaction volume, that's been elevated for a while. Low inventory, that's been true for a while. But this is now sellers affirmatively pulling themselves out of the market because they have become so concerned about the uncertainty that they're thinking, maybe even though I need to, I'm maybe better off staying at what I already know that I have. I know what my cost structure is. I know that, it's suboptimal, but I can stay for a while longer. I need to sell, but I don't need to sell now. I could sell, maybe I could try selling in 3 months or in a year or something like that. Great. So we've now seen deterioration on the buy side, deterioration on the sell side, deterioration in the quality of the contracts, right? All of the metrics that we can look at, except pricing for single family homes, have been showing real stress. And this is a change in the characterization of the marketplace from stressed to real stress. Now, when I say unhealthy market, again, it does not mean collapsing, doesn't mean it's disappearing, doesn't mean home ownership is going out of style or anything like that. So think for a second about, somebody's had a bad flu and you thought they were going to, or you or they were going to get better. And finally you decide, you know what, it's time to go to the hospital. And in the hospital, you're diagnosed with RSV or pneumonia or something, right? And in the hospital, you stay there for not just an overnight or not just for a couple hours, but maybe for a couple weeks, trying to get better. It doesn't mean it's terminal, but it means there's a characterization change that we have to recognize with regard to the health that somebody thought that they were actually experiencing. Well, that's what's going on in the real estate market now in Las Vegas. We've moved into an unhealthy market where both buyers and sellers, even need to buyers and sellers, are pulling back from this market. A lot of it's because of uncertainty. Interest rates probably having a lesser impact now than what they'd had before, right? So this extreme uncertainty and these pullbacks, these are taking place in the face of high but lower mortgage interest rates, right? Will mortgage interest rates continue to go down? I don't know. We're going to see a lot of inflation in March and possibly in April and maybe continuing for a while because of oil prices going up as significantly as they are. And yes, it's true, food and energy sometimes get stripped out of looking at the consumer price index numbers, but energy prices in particular spread throughout the entire purchase complex, right? It makes manufacturing more expensive, it makes distribution more expensive. So that's an inflationary shock that we've just had. And by the way, in the early 70s, in 73, 74, and then again in, I think it was 79, we had these kinds of energy inflationary shocks that ended up causing inflation in the US to increase from something around 3.5%, 4%, up to something significantly higher, such that the Federal Reserve increased interest rates really dramatically, where we ended up looking at 18% mortgage interest rates, right, in order to try to pull this inflation out of the economy. I'm not predicting 18% mortgage interest rates, but I'm telling you, irrespective of who the Fed governors happen to be at any particular time, who the chair of the Fed happens to be, it won't matter, because the Fed could lower Fed funds rate. Long-term interest rates are not going to come down in this kind of environment, except maybe volatility, a spike down for a day or two, right? Interest rates are not going lower. They're going to either remain the same or they're going to be going higher, okay? All right, so that's where we are as we enter into March, as we enter into the last month of the first quarter of the year. Sales below 2 months in a row, below the weakest year in Las Vegas history, going back at least to the 70s, to the oil crises of the 70s. Listings, new listings, as well as inventory, incredibly weak, right? Inventory, if we were to parcel out between real and fake, we're looking at less than a third of normal inventory. And new listings, when they should be going up strongly, going down in all submarkets, while contract failures remain really elevated. Okay, so I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. We help people actually build wealth through real estate by understanding what's going on in the market, to be able to structure opportunities that make sense, where you can capture gains as either a buyer or a seller. If you find this information helpful, usable, please share it with your neighbors, your friends, your colleagues, your family members, anyone who you know might be about to engage in or thinking about engaging in a real estate transaction, because we can actually really help make sure that you've got contracts that are stable, that are going to complete, to understand where pricing should be, to understand where buyers and sellers are likely to be coming from, and to understand what the opportunities are more broadly within real estate in the Las Vegas Valley. I look forward to seeing you in the next video. Thanks.